Buy now and pay later stocks like Zip and Afterpay. Is it too late to invest in these? What is up everyone, it's David here. It seems that over the last couple of weeks, we are just a few comments away from someone saying
Zip to the moon, or how much money they have made buying and selling Afterpay.
So in this video, let's talk about two main things. One, my take on both Zip and Afterpay, and two, whether if it is too late to get in on these buy now, pay later stocks. As usual, we'll finish off this video with how badly the markets have destroyed my portfolio over the last week, and my take on Zip's management team selling almost $48 million worth of shares. Oh, if you appreciate me condensing everything into a small YouTube video for you, make sure you gently smash that like button right there, and when that button turns blue, you know you did a very good job. Now without further ado, let's go! Now in order to answer whether if it is too late to get in on these buy now, pay later stocks, let's quickly go over the key differences between Zip and Afterpay, their financial performance along with their economic moat, and most importantly, their management team. Now in the simplest form, buy now pay later works like this. The consumer buys a product from the merchant, and when the transaction is complete, the buy now pay later company will pay the merchant a lump sum minus its fees. And at that moment, all of the credit risks on the merchant side will be passed over to the buy now pay later company. Now, this is one of the major reasons why merchants really love buy now companies. It's because it helps with cash flow. And at the same time, it reduces the rate of abandoned cart, which is incredible at a time like this when they really need the revenue. Now, there are really three key differences between Zip Money and Afterpay. Now, with Afterpay, the repayment period is 4 installments over 8 weeks. But with Zip Money, you get to choose how and when you pay with a 3-month interest-free period, and after that, it's sky-high interest rates. The second difference is fees. Merchant fees is a little bit higher on the Afterpay side and a little bit lower on the Zip Money side. The most important difference between the two is their approval process. With Afterpay, they don't do a credit check, but every single transaction needs to be approved every time. With Zip Money, they do a credit check, and it's more like a line of credit. Once you get approved, you always have that line of credit and you can increase it if you want to. Now keep the approval process in mind because that will really make or break a company in the future, and I'll talk about that in just a second. Alright, let's talk about numbers. What we're really looking for in their numbers is their revenue growth, strength in balance sheet, and customer retention. And most importantly, because they are credit companies, we need to look at their rate of defaults. So let's start with revenue growth. Afterpay have grown its revenue by 208% since 2017. And Zip have grown their revenue by 168% since 2016. Both companies are aggressively chasing after market share. But Afterpay really benefited from going after the US market earlier than Zip. And they went with an influencer like Kylie Jenner, and that skyrocketed their brand presence as well as their revenue growth. But of course, by now you should know that Zip is giving Afterpay a run for their money by acquiring QuadPay in the month of June, adding 100,000 new customers per month, which is approximately 35% of Afterpay's rate of customer acquisition. Okay, what about their balance sheets? With Afterpay, their balance sheet looks really strong. Their short-term assets well cover the short-term liabilities and the long-term liabilities. Actually, more than 2 times over. So they should be able to weather the storm with no problem. Now with Zip, it still looks good. Short-term assets well cover short-term liabilities plus long-term liabilities. But in comparison to Afterpay, their balance sheet isn't as strong. But they should be able to withstand any external shocks without a problem. And customer retention. Now when it comes to customer retention, it's not the first slice of pizza that matters. It's people coming back for the second or third slice. Because the second and third slice of pizza indicates that the customers really love that product and they want more of it. More importantly, having customers coming back for more means that the company is also making more money out of the single customer that they acquired. And this is a key metric to look at for long-term profitability. Now, with Afterpay, they talk about their purchase frequency very transparently. The customers they acquired in 2015 and 2017 financial year purchased 23 times a year, and the rest speaks for itself. But with Zip, they only publish the percentage improvement in transaction per active customer and not the number of transactions. So it's likely we'll have to wait till reporting season to see how often customers actually transact. The reason why I put so much emphasis on the number of transactions is that the more people transact with buy now pay later companies, the more money they will make. And because they are credit companies, we have to dig into their default rates. In their most recent half-yearly report, Afterpay's net transaction loss is 0.5%, whereas Zip Money's net bad debts is 1.68%. Now, the major difference between the two default rates is really on the approval process for consumers. Remember, for Afterpay, every transaction needs to be independently assessed and approved, and for whatever reason the consumer is no longer worthy, they can't use the service anymore. Whereas with Zip, it's a line of credit. And it might be harder for you to get approved initially, but once you get it approved, you have that line of credit. Now, the thing to remember here is that the buy now, pay later stocks are borrowing money from the banks in order to pay the merchants a lump sum. Now, if the consumers default on any of these transactions, the debt that they borrow from the banks doesn't disappear. And that means the buy now, pay later companies have to earn more money more quickly in order to pay back the principal plus the interest. And as you can imagine, this will quickly spiral out of control if you don't have proper measures to manage your default rates. Now, when it comes to their moat, this is probably the most controversial, and I gotta sit down for this. This is my own opinion, so make sure you take it with a grain of salt. For those of you unfamiliar with moats, it's essentially competitive advantages that will keep your competitors at bay, preventing them from eating away a big chunk of your market share. Now, with buy now, pay later companies, it's a common school of thought to say they have no moat. But let me present a different view. I think they have two distinct moats. The first is their ability to create deep relationships with millennials. The second is their local plus global network effects. Let me explain. It's true that there is nothing stopping credit card companies and banks deploying a crap ton of cash and basically just take over. But connecting with millennials really isn't their strength. And this is where buy now, pay later companies have won over the hearts of consumers with influencer campaigns with Kylie Jenner and the ubiquity of their presence at the checkout. At the same time, as buy now, pay later companies acquiring more customers both domestically and internationally at the checkout, more merchants are flocking to them because they want the access to that pool of customers as well. So this creates a network effect both domestically and internationally. Now, network effects are known to be one of the hardest competitive advantages to erode. And the more market share you own, the more your network effect will evolve into a higher switching cost. Because if customers are really used to a particular service, you need a significantly better offer to persuade the customers to try something different. Frankly, I just don't think it's enough to get people to switch and try something different by offering them multiple installments on their Master or Visa credit cards.
Because the perception of credit cards amongst millennials are awful.
Now, according to a NerdWallet study earlier this year, millennials were the most likely generation to say they regret their credit card debts. Well, you know what they say. If you can't beat them, join them. And Visa and MasterCard are starting to do that with Afterpay. Buy now, pay later type companies' moats are still very fragile. And since they rely on the checkout infrastructure to acquire brand new customers, if you take that away from them, their ability to acquire brand new customers will be very hamstrung. And of course, one of the largest e-commerce platforms, Shopify, has already started offering that service in the US. Exactly the same as Afterpay. 4 installments, interest-free over 8 weeks. When it comes to the management team, I personally prefer co-founder-led companies, especially if they have a high ownership stake in the company. Because having a high ownership stake means that they got skin in the game. And having skin in the game means that they are incentivized to act in the best interest for the entire company. And early in the company's life cycle, you want the co-founders to lay the foundation of their vision before you get a professional CEO and build on it. So both Zip and Afterpay are still co-founder led, which is incredible, and both of them still have very high ownership stakes, even though one just offloaded almost $48 million worth of shares, but we'll talk about that in just a second. On top of that, you want to stalk the CEO on LinkedIn to see what they've done in the past and whether they have experience relevant to the problem that they're trying to solve in the company. And the more relevant their experience, the better the company will navigate future problems. This is not really a hard and fast rule, but it does help. Now the thing is, I don't put a lot of emphasis on the rest of the management team because everything starts at the co-founder layer. If they are disciplined, aggressively chasing after market share, and understand how to build a product that people love, they will naturally be able to attract incredible talent. Without that, recruitment is incredibly difficult. So then the final question is it too late to get in on these buy now, pay later stocks? First, there will never be a point in the future where the stock looks cheap. So these growth stocks is really not a place where you wait for it to become undervalued and then go in. The real question is, based on everything we just covered about both companies, what do you think they will be in the future? For me, I think that banks and credit card companies got nothing on these buy now, pay later companies, because their relationship with millennials is just absolutely awful. At the same time, I anticipate that once the incumbents realize that they cannot beat these buy now, pay later type companies, they'll join them. And we're already starting to see that with Westpac buying an equity stake in Zip and CBA taking a massive equity stake in Klarna. But the long-term success of these buy now, pay later type companies will depend on its ability to evolve to become something more than just a payment company for discretionary spending. And we're seeing that already with Zip getting into the billings market. So personally, I don't think it's too late to get in on these buy now, pay later stocks, because I really think this is just the beginning. But I will wait a couple months until August and September so that we can see updated statistics about their new default rates, the government stimulus and how that's affected consumer discretionary spending. Because this is really the first time that these buy now, pay later type companies have experienced a downturn. And you really want to get an idea of how they navigate through these tough times, because that will give you a hint on how they're going to perform in the future when another downturn happens. Okay, just a quick update on my dividend growth investing portfolio. On the Australian side, not much is really happening. And since the beginning of the week, I lost about maybe $600. But if you've been following me, I just want to remind you that I don't check my portfolio value that much, because I acknowledge that the share price is going to go up and down, and I'm not really too fussed about it. My dividends haven't really been cut since majority of the dividends were paid early in the year. So I was already paid those dividends. But yes, the bank's dividends did get cut, well, at least some of them, but we'll see how the other banks will pan out when it comes to their dividends. Now, I think what's more interesting is my stake portfolio. Now, with my stake portfolio, US seems to be impacted a lot heavier, mainly because there's a lot more new numbers coming out when it comes to the pandemic and also the very turbulent political environment over there as well. So I don't really think that has helped in both the recovery of the pandemic and also the recovery of the economy as well. So we really have to see over the next couple of weeks how things pan out. These political tensions have really caused people to gather in big groups, and big groups aren't really that conducive in helping to keep the pandemic numbers down. So there's a lot of different factors at play over there in the US. I'm keeping an eye on things. I'm not changing my strategy by any means. I'm still going to keep investing the same amount every single month. And in the next couple of weeks, hopefully, I'll get my first YouTube check and I'll show you what I'm going to be buying on the stake side of things. On the conversation of Zipco insiders selling almost $48 million worth of shares, I want to remind you that it's okay. It's absolutely okay for co-founders to lock in a bit of wealth that they've created for themselves. If you worked in a startup in the past, the amount of sacrifice that you will have to do for the early stages of the company all the way to going public and then scaling the public company, you sacrifice a lot. Family time, time with friends, it's basically whatever it takes to make the company successful. So honestly, when co-founders sell a portion of their shares to lock in a bit of wealth, I don't have any problem with that, because considering the amount of effort and the sacrifices that they've made, it's absolutely, in my opinion, very fair for them to lock in a bit of wealth. I will be more worried if they sell all of their shares. And fortunately, they didn't. So offloading some shares to lock in a bit of wealth, not a problem at all. I don't think anything is going to change. It's not really a big deal. The share price have corrected a little bit since they sold, but frankly speaking, this is just noise in my opinion. If you work that hard to make a startup work, to get the amount of funding necessary to go public and then scale a public company, you deserve a bit of reward. So for me, not a problem. Shout out to Larry Diamond for being able to build such a great company in the first place. And we'll see how the company pans out with their QuadPay acquisition for the remainder of the year. And that's essentially it for this video. Did you agree with my view on the economic moats? I would love to know what you think in the comment section below. And as usual, if you want to support me, just gently smash that like button right there, and that will mean the world to me. Now, before you go, I have a bonus tutorial video coming up showing you how I do my research step by step. So make sure you subscribe to my channel, click onto the bell. When that video is ready, you be the first one to know. And as usual, Otto will always do the honors and see you very, very soon.